Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The key currencies you want to buy in an optimistic environment, obviously the Australian dollar and Canadian dollar in this type of thematic, because the optimism is flowing from China again. China is the driver of this near-term optimism. Their stimulus is working, their demand's going to rebound, they're stockpiling commodities, and if they're stockpiling commodities, they're buying commodities from the commodity producers. And of the major currencies, that's Aussie and Canadian dollar. And sure enough, they've been the ones that have moved the most on this move. Excuse me. The euro as the dollar alternative is another currency you want to target on this optimism. Again, people have moved back on that major risk aversion fear trade. They've moved into the dollar not because they like the dollar, but because they had to get out of other asset classes and hide. Here they are now. Some optimism is there. The euro is going to tend to be the mirror image of the U.S. dollar index. That's because the euro really is the main alternative currency against the dollar because of its depth of its consumer and its capital markets in general. So in this optimistic move, the euro, of course, would be another one. This would be our first choice. And you often see a relief rally in these periods of optimism, or these ebbs of optimism, assuming that's it, and this is not, again, a change in the major trend, which we'll only know with hindsight. But again, we're going to track that with our intermarket relationships. Those currencies that have been killed get a relief rally on here, and the British pound has been an example and has surprised us, the huge bounce we've seen in the British pound on this spurt of optimism. Maybe it's the fact that all the bad news is in the pound. Maybe it's the fact that maybe the pound is not part of the European Monetary Union and why the euro has lagged on this bout of optimism. We're not sure. But in general, just keep in mind a relief rally. Those who have been hit the hardest are going to tend to do fine. Emerging market stocks and oil show global growth. Here's how we also use these key intermarket asset classes to give us an environmental shift. Of all the stock markets, obviously the emerging markets, because of the nature of them, it doesn't take a lot of money to move them relative to the U.S. stock market. They're going to tend to move faster and go farther in a risk appetite environment because people want to get involved in this big capital gains move you generally see in emerging markets. Their GDP is growing faster. Corporate earnings are going to tend to come in more, all of that stuff, so to speak. So you tend to see the emerging markets move faster. But what you also want to see not only is just the emerging markets popping. That could be a false rationale. You want to see some fundamentals behind this that make sense. And really the key fundamental in the global economy is oil, and it's why we track oil every day. We watch oil. If this move were doing this and oil stayed flat in here, we'd say that'd be a big divergence. Somebody's wrong in here, and we would think the emerging markets are overdone on optimism. But that's not happening. What's happening is we're seeing the move in the emerging markets, and we're seeing a move in oil too, which suggests that this move may be for real, and we really have to be open to it because in general, the global demand backdrop drives oil, and if the global demand isn't there, oil will sag because of it. It doesn't mean oil can not get ahead of itself at times, again, not move up on some optimism, but you have two decent asset classes, one supportive here, which means we have to be open to the fact that this change, which we think is a false dawn, may have legs. It may be many, many more months in this move. It's still not invalidated a longer-term trend because of the fact we're seeing some supportive real asset move behind it. So that's the way we tend to use the major asset classes together to get a feel for this move. Same chart I just showed you before, crude oil in black, emerging markets in red, but I overlaid our risk appetite currency on there, which of course is the Australian dollar. And sure enough, the Australian dollar is moving up, right in line with the emerging markets. It's really playing that risk appetite role as it does. So that very, very clearly is showing you the environment we're in. Crude oil is supporting it as a commodity currency. Commodities in general have bounced very nicely off the bottom. So, again, very clear by this that the Australian dollar is your key risk appetite currency you have to keep in mind, which means it sets up opportunities on the upside and downside when you see a very clear delineation in these risk environments. The Aussie is one I think you always want to play if you think you have a very good grip on a shift in the risk environment. Stocks and bonds in here. One of the things that hasn't been confirmed quite yet on a longer-term basis are U.S. stocks and bonds. Granted, we've had a very, very nice move in stocks off of the bottom here. And let me grab my pen. Very, very nice move in here in stocks, up about 30% from the low. A risk appetite move. We've also had a decline in bond prices, Treasury bond prices, which reflects the fact that people are coming out of this safe haven trade, coming out of bonds. Interest rates are going up. That's telling us that things are loosening up a bit. People are coming out of the hiding place and into risk assets. So you see it here. You see this corresponding relationship, very clear. But you also see is the fact that the bonds haven't broken down through support, nor has the stock market broken through this near-term resistance. So it puts you on alert to the idea in the background, hey, maybe this is still a false dawn. We have to be open to the fact that, yeah, it's been a very good move. And again, if we're longer-term time frames traders, we still want a little more. We just want some more validation before we jump into this move. And I think the validation comes watching these two asset classes, and we watch these every day. So if we break through this resistance here and the market breaks above, if we break through support here or break above resistance here at the same time, we have two major supporting asset classes to say this risk appetite move could have legs and move a lot farther. And if that's the case, we probably want to be out of the dollar and into something else, whether it again is in the euro or in the Aussie, etc. So in summary, you're going to try and discern the risk environment that you're in. And you can do that just from your background reading and look at some of your longer term asset class charts and looking for just changes in correlations, and they're going to tend to move together. It's not as hard as you think to do that, looking at weekly charts in those time frames. You're not going to move on every ebb and flow. You're going to wait for some validation in the various asset classes, and you're going to also use some of your technical analysis to help support this. I think it's always important to try and define the risk environment in both the long and short-term time frames. It's not always going to be as clear-cut as it is here and it is now, but I think you can do a pretty good job by using these key classes that I showed you to define these environments that will set up trades for you. It'll put you in the ballpark to set up trades. If everything's turning down, if all the stock market's starting to turn over and commodities are starting to break globally, you probably don't want to be short the dollar in a very, very big way if it's a potential for another risk-averse move. That leads to another point. We have to be open to the idea that these correlations, which have worked in the last cycle, may change. And what I mean, let me give you an example. And I don't have the chart here. I sent it to clients today. One of the things changing recently is the fact that the U.S. stock market has been going lower, and the U.S. dollar has been going lower at the same time. We're now in a short-term period in which the dollar is no longer playing the risk aversion role, meaning the dollar is not getting a safe haven bid. Stocks are breaking, commodities were lower today, and guess what? The dollar got killed. The euro rose, the pound rose. We didn't get as much of a move in some of the commodity currencies. The yen continued to rise to our chagrin. That's a change in this correlation makeup of everything I just showed you. So you're going to see that, sometimes over a few day or a multi-week period. You have to be open to the idea that who knows? Maybe this is a major change in everything I've said here in terms of the risk-averse environment.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.